Imagine you have $10,000 sitting in a shoebox. Or maybe it is a standard checking account. The location does not really matter. By next Tuesday, that $10,000 is only worth $9,900. By the following month, it has lost another chunk. You did not spend a dime. You did not make a bad trade. You just let it sit there. We are taught from a very young age that saving money is the path to wealth. We are told to stash it away for a rainy day, to be prudent, to be safe. But here is the uncomfortable truth that banks and financial advisors usually gloss over. Saving money, in the traditional sense of hoarding cash, is a guaranteed way to lose wealth. In the current economic environment, saving is not safe. It is actually a slow, silent financial bleeding that punishes you for being responsible. If your goal is financial freedom, the first thing you need to do is stop saving. I am not telling you to go out and blow your paycheck on luxury cars or watches you do not need. That is obviously foolish. What I am talking about is a fundamental shift in how you view the utility of cash. There is a massive difference between saving money and deploying capital, and most people spend their whole lives stuck in the first category, wondering why they never get ahead despite pinching every penny. Today, I want to walk you through the math of why savers are losers, financially speaking, and exactly what you should be doing with your liquidity instead. We are going to break down the inflation trap, the banking scam, and the specific asset allocation protocol I use to make sure my money is actually working, not just sleeping. Before we dive into the numbers, do me a favor. If you want to stop losing purchasing power and start building equity, hit that subscribe button. It is the best return on investment you will get on your time today. Now, let's look at the first major trap, the safety myth. The safety myth is pervasive because it feels intuitive. Cash feels safe. You can hold it. You can see the balance in your app, and the number does not fluctuate wildly like the stock market. If you have $50,000 in the bank today, you will likely have $50,000 there next year. That stability creates a false sense of security. It feels like you are preserving value. But this is where our brains fail to understand the difference between nominal value and real value. Nominal value is the number on the screen. Real value is what that number can actually buy at the grocery store or the gas station. We have been conditioned to worship the nominal number. We celebrate when our savings account hits a milestone, even if the cost of living has doubled since we started saving. The reality is that cash is not a store of value. It is a melting ice cube. And the rate at which it melts isn't random. It is a feature of the system, not a bug. Let's run the hard numbers on this because they are uglier than you might think. We usually hear about inflation being around 2 or 3%. That doesn't sound too scary. But let's look at a period of higher inflation, say 5%, which is conservative given recent history. If you hold $100,000 in cash and inflation is running at 5%, you are effectively paying a $5,000 tax every single year just to hold that money. But it compounds. In just 14 years, at a 5% inflation rate, your $100,000 will only buy $50,000 worth of goods. You have lost half your wealth without spending a penny. Even at a healthy 3% inflation rate, your money loses half its value in 24 years. So, if you are saving for a retirement that is 30 years away, and you are doing it in cash, you are guaranteeing that you will be poor when you get there. You need to save double the amount just to stay exactly where you are today. That is a treadmill you cannot outrun. So why do we do it? Why do smart people hoard cash when the math clearly shows it is a losing proposition? It comes down to loss aversion. In behavioral economics, we know that the pain of losing money is psychologically twice as powerful as the pleasure of gaining money. If you invest that cash and the market dips 10%, you feel physical pain. You panic. You feel like you made a mistake. But when inflation eats away 5% of your purchasing power, you don't feel it immediately. It is invisible. It is a silent theft. Because the number on your bank statement didn't go down, your brain tells you that you are safe. You are being boiled like the proverbial frog. You don't notice the water getting hotter until you are financially cooked. We prioritize avoiding short-term volatility over avoiding long-term ruin. We would rather lose money slowly and surely than risk losing money quickly, even if the risk brings the potential for growth. It is a psychological trap that keeps the middle class poor. Here is the protocol to fix this. You need to establish a strict cash drag limit. This is the maximum amount of cash you are allowed to hold at any given time. For most people, this should be 3 to 6 months of expenses. That is it. Anything above that number is not savings, it is waste. It is idle capital that is rotting away. Once your checking account hits that limit, every extra dollar must be evicted immediately. It needs to be deployed into assets that appreciate or generate yield. You have to treat excess cash like a hot potato. Do not let it sit there waiting for the perfect time to invest. The perfect time was yesterday. The second best time is right now. By setting a hard ceiling on your cash holdings, you automate the discipline required to beat inflation. You remove the decision fatigue and the emotional hesitation. Now, you might be thinking, okay, Tom, I get it. Inflation is bad. But at least my bank pays me interest, right? That has to count for something. If you think your savings account is helping you fight inflation, you are falling for the oldest trick in the financial book. The bank is not your partner. They are arbitrageurs using your money to make themselves rich while throwing you crumbs. If you think the inflation math was depressing, wait until you see the spread the banks are making off your deposits. This is where the scam really operates. Most of us grow up viewing banks as a public utility, a safe vault where we store our labour. We give them our money, they keep it safe, and maybe they give us a free toaster or a fraction of a % in interest. It seems like a fair trade. But let's look at the business model of a bank. They are not in the storage business, they are in the lending business. When you deposit $10,000, they don't lock it in a vault with your name on it. They immediately turn around and lend it out. They lend it to your neighbour for a car loan, to a business for a line of credit, or back to you for a mortgage. The myth is that your savings account is a service for you. The reality is that your savings account is cheap raw material for them. You are the supplier of capital, but you have zero negotiating power on the price of that capital. You are effectively an unpaid investor in the bank's lending portfolio. Here is the math of the arbitrage. Let's say you have a traditional savings account at a big commercial bank. They might be paying you 0.01% interest. On $10,000, that is $1 per year. That is not a joke, that is the actual rate from many major banks. Meanwhile, they take that same $10,000 and lend it out as a personal loan at 10%, or a credit card balance at 25%. Let's be generous and say they lend it out at a conservative 5%. They are paying you $1 and making $500. That is a massive profit margin on money that isn't even theirs. Even with high yield accounts paying 4 or 5% right now, that is only happening because the federal funds rate is high. The moment rates drop, your yield will vanish, but the bank will still charge high interest on credit products. They keep the spread, you take the inflation risk. It is a mathematically terrible deal for the depositor. Why do we accept this bad deal? 2 words: FDIC insurance. We are terrified of losing our principal. The government guarantee that protects deposits up to $250,000 is a powerful psychological comfort blanket. We are willing to forego massive potential returns and suffer guaranteed inflation losses just to know that the number cannot go to zero. Banks know this. They know that safety is their primary product, not return on investment. They leverage your fear of the stock market or real estate crashes to keep you parked in low-yield accounts. It is the price of peace of mind. But as we discussed earlier, that peace of mind is an illusion because the purchasing power is eroding anyway. You are insured against bank failure, but you are not insured against currency debasement. You are prioritizing the safety of the container over the safety of the contents. The solution here is to stop being a lazy lender. If you must hold cash, for that emergency fund we talked about, you need to optimize it. Never leave substantial money in a checking account or a standard savings account. At a minimum, it needs to be in a high-yield savings account, HYSA, that moves in lockstep with the Fed rate. Even better, look at money market funds or short-term treasury bills. These are almost as safe as bank deposits. Treasuries are backed by the US government, which is the same entity backing the FDIC, but they cut out the middleman. By buying T-bills, you are lending directly to the government rather than lending to the bank, who then lends to the government and keeps the difference. Today, with apps and brokerage platforms, buying treasuries or money market funds is as easy as transferring money to savings. The protocol is simple. Check the yield on your cash every month. If it is not within 0.5% of the federal funds rate, move it. Make the banks compete for your capital. This leads us to the most dangerous trap of all. You have probably heard the advice that to get rich, you need to cut out the lattes, stop buying avocado toast, and clip coupons. This is the scarcity mindset, and it is where conventional wisdom gets it completely backward. I'm going to tell you something that might hurt to hear. You cannot save your way to wealth. You can starve your way to a slightly larger bank account, but you cannot pinch pennies into millions. Focusing on saving $5 on coffee is actually costing you thousands in lost focus. The myth is that wealth is the result of extreme frugality. We see headlines about the billionaire who drives a 20-year-old car and think, aha, that is the secret. So we start obsessing over small expenses. We drive an extra 5 miles to save 3 cents on gas. We deny ourselves small pleasures like a coffee or a subscription service, thinking this sacrifice is building our empire. This is defensive financial management. It is playing not to lose. But wealth is a game of offense. The problem with the scarcity mindset is that it consumes a massive amount of mental bandwidth. Every time you agonize over a $5 purchase, you are burning decision energy that could have been used to solve a $5,000 problem. You are training your brain to look for limitations rather than opportunities. Let's look at the math of the floor versus the ceiling. There is a hard floor on how much you can save. You have to eat, you have to live somewhere, you have to wear clothes. Even if you lived like a monk, you could maybe cut your expenses by, let's say, 30%. If you earn $50,000 and spend $40,000, the absolute maximum you can create through saving is that $40,000. You cannot save more than you earn. But there is no ceiling on income. None. You can earn $100,000, $500,000, $1 million. The upside is infinite. If you spend 20 hours a month figuring out how to save $200 on groceries, your hourly return on that effort is $10. If you spent those 20 hours learning a high-value skill or building a side business, your return could be hundreds of dollars an hour. Mathematically, focusing on the expense side of the equation has diminishing returns, while focusing on the income side has exponential returns. There is also a psychological cost to this extreme frugality. It is called willpower depletion. Willpower is like a battery. It drains throughout the day. If you spend all day resisting the urge to buy lunch, resisting the urge to upgrade your phone, and stressing over the electric bill, you deplete your reserves. When the big decisions come along, like whether to negotiate for a raise, or whether to invest in a risky but promising asset, you are tapped out. you revert to safety. Furthermore, living in a constant state of deprivation often leads to revenge spending. You snap. You feel you have suffered enough, so you blow a huge amount on something stupid, erasing months of discipline in one weekend. It is a cycle of binge and purge, just like a bad diet. Sustainable wealth comes from abundance, not restriction. So here is the protocol. Switch from defense to offense. Audit your expenses once, set them on autopilot, and then ignore them. Stop looking for coupons. Instead, dedicate that mental energy to increasing your shovel. If you can increase your income by 20%, you can inflate your lifestyle by 10% and still save double what you were saving before. The goal is to widen the gap between income and expenses by pushing the top line up, not by crushing the bottom line down. Ask yourself every week, what did I do this week to increase my earning potential? If the answer is nothing because you were too busy trying to save $5 on detergent, you are failing the protocol. Prioritize career growth, side hustles, and scalable income over penny pinching. Now, once you have increased that income and you aren't letting it rot in a bank account, where does it go? Most people stop here and lose huge amounts of money because they dump it all into the stock market without a plan. Or worse, they buy stuff they think is an asset, but is actually a liability. I'm looking at you, car enthusiasts. We need to talk about the only type of spending that actually makes you richer. This isn't about buying stocks, it's about buying cash flow. The biggest myth in personal finance is the definition of an asset. Your house is likely not an asset. It is a liability that you live in. Your car is definitely not an asset. An asset is something that puts money in your pocket. A liability takes money out. When I say stop saving, start spending, I mean start spending on assets. The wealthy do not have large savings accounts, they have large portfolios. They are cash poor and asset rich. They constantly move liquidity into things like dividend stocks, real estate, businesses, or intellectual property. The goal is to get to a point where your assets generate enough cash flow to cover your living expenses. That is the definition of financial freedom. It isn't a number in a bank account, it is a ratio of passive income to burn rate. Let's look at the compounding math. If you save $10,000 a year in cash, after 20 years you have $200,000, minus inflation loss. If you invest that same $10,000 a year into a boring index fund, returning an average of 8%, you have nearly $500,000. The money you earned from your money is greater than the money you earned from your job. This is the inflection point. But let's take it a step further. If you invest in cash-flowing assets, like a rental property or a dividend portfolio, you are creating a machine. If you can build a portfolio that yields 5%, you need roughly $1 million invested to generate $50,000 a year. That sounds like a lot, but remember the rule of 72. At 8% returns, your money doubles every 9 years. The first 100,000 is the hardest. The second 100,000 comes much faster because the first 100 is helping you pull. The barrier here is fear of volatility. You look at a stock chart and see it zigzagging. You see red days. You hear news about recessions. It feels safer to keep the money in cash, where the line is flat. But you have to reframe your psychology. Volatility is the price of admission for returns. If there were no risk, there would be no premium. You are being paid to endure the emotional roller coaster. The person who cannot handle seeing their portfolio drop 20% temporarily is the person who will work until they die. You have to detach your emotions from the daily price action. Realize that when the market is down, you are buying assets on sale. When you go to the mall and jeans are 50% off, you don't panic, you buy 2 pairs. Yet when the stock market is 50% off, people run for the exits. This is the psychology you must break. The protocol for this is automation. You cannot rely on your willpower to invest every month. You will find a reason not to. You will say, "The market looks high," or "I have a vacation coming up." You need to set up automatic transfers that happen the day your paycheck hits. Money leaves your checking account and goes directly into your investment accounts before you even see it. It is the pay yourself first principle. If you treat investing as a bill that must be paid, you will adjust your lifestyle to fit what is left. If you try to invest what is left after spending, there will be nothing left. Set it, forget it, and let the compounding do the heavy lifting. So, let's recap the strategy. Stop saving in the traditional sense. Stop hoarding cash that is being eaten by inflation. Stop lending your money to banks for free. Stop stressing over $5 lattes and start stressing over how to increase your income. And most importantly, start aggressively buying assets that pay you to own them. Money is a tool, not a trophy. It is meant to be used, circulated, and deployed. If it is sitting still, it is dying. The shift from a saver identity to an investor identity is the most important financial move you will ever make. I want to challenge you to look at your bank accounts today. Calculate your cash drag. How much excess liquidity are you holding out of fear? Take that number, run the inflation math, and realize how much it is costing you. Then, make a plan to deploy it. If you found this breakdown helpful and you want more no-nonsense financial protocols, make sure you are subscribed. I've got a deep dive coming up on exactly how to allocate that first $10,000 of investments, and you don't want to miss it. Thanks for watching, and I'll see you in the next one.